What I like about the way in which you look at the world, Michael, is through those second derivatives, right? You look through rates of change, and I kind of put this out there the other day. I'm trying to remember who I spoke with about the point you made, which was they had a chart. I'll see if I can find it. If I can, I'll put it up here. But it shows that the current rate of Fed tightening, or the current rate of Fed interest rate hikes, is the highest it's been in the data series, right? And I likened this to taking a gallon of water. Michael, I could give you a gallon of water and give you a week to drink it, and you'd have no problem, right? Or I could shove it up against your face and force it down your throat all at once, and you'll drown, right? And that shows, basically the importance of rate of change in the equation. And if I understand you correctly, you feel like, what's going on right now with the tightening and the hiking is a lot like that sort of waterboarding, immediate waterboarding that may actually, cause the economy to choke, sputter out, whatever. You're laughing as I'm saying this, but is this hitting home in any way for you?
Thank you. I was going to say, thanks for trying to waterboard. The last time the Fed hiked rates above 2.25% was in the summer of 2018. By the end of that year, by the end of 2018, the S&P dropped 20% and the Russell 2000 dropped 30%. Back then, GDP growth was 3%. Today, it's 0%. And I'm being generous right now.
You are being generous.
I'm being generous. It's, we had 2 back-to-back quarters of contracting economic growth. Q3 could have a small positive, 0 point something, maybe even as high as 1. It's just too early. We don't have a lot of data. But the last time we were here, the stock market just went off a cliff in the context of much stronger growth, much less QT. We have much stronger QT now and much weaker growth. So, oh, by the way, I have to add this. The market cap to GDP that we have now is higher than it was in 2018. And the leverage in the economy today is much higher than it was in 2018. So there's no reason why the level of interest rates that it takes to break the economy, which is always falling since the year 2000, it used to be 6%, and it was 5%, then it's 2.5%, then it was 2.25%. Mm-hmm. We're here now. We're at that juncture, that threshold where things tend to break down. And I looked through all of the metrics that I thought were, salient, that would make me think that this period of time would be better, and they're all worse. We are much more leveraged, have much more debt, much weaker growth, much higher rate of QT, and even a higher interest rate, at least as projected by the intentions of our Federal Reserve.
Right. So on that, you just a few minutes ago said that just on the current trajectory, you expect us to be at a federal funds rate of like 3.3% or something like that for the end of the year. Can this over-leveraged economy handle that?
No, I think I just went through all the reasons why. I mean, this is what I said I think the first time I came on with you was in July of 2021, and I said why this economy was going to break. It's just massively over leveraged. We're at record total debt, nominal terms. In terms of GDP, we're at 345% total debt. That ties an all-time record. Guess what date? December of 2007, which was the precipice of the global financial crisis. So we have the most leverage we've ever seen in nominal terms, and even as a percentage of phony GDP, which is predicated mostly on printing money.
Right.
We're at that threshold, and I don't think it can handle that. The total market cap to GDP prior to the great the global financial crisis was 100 and I believe it was 104% of GDP. As we speak, it's 166% of GDP. It topped out at 210% of GDP. So we have a much more over-leveraged economy and a much more over-leveraged stock market.
Okay, great. So look, for all the reasons you gave us in this last one, that just sort of even just mathematically by your calculations, we're going to be beyond the mathematical breaking point for the economy around leverage within just 6 months or so. All right, so now we go to your market outlook here, right? So clearly the market has not got this memo, Michael, because everything you're laying out here seems to suggest that lower, perhaps vastly lower asset prices should lie ahead for all the reasons we talked about. So you say that we're in a bear market. So I assume you think the bear market is definitely not over yet. You've just explained that kind of, the full impact's going to be felt in the not too distant future. That's only about end of the year is only less than 2 quarters away now. So answer this any way you like, but how far low do you think things have the capacity to go, and how fast do we get there? Do we stumble along for the rest of this year, or is there going to be a point relatively soon where the market just is forced to catch on and prices have to start being adjusted downward?
Yeah, it's only God knows exact timing of these things. So, you can use
Absolutely. I'm asking you to prognosticate as best you can.
Math and models is, all we have, and they're imperfect. But based upon the trajectory of the Federal Reserve and how overvalued we are in the stock market, it wouldn't surprise me at all if towards the end of this year and in spring of 2023, we saw a 40% decline plus from where we are right now. And that would just bring the total market cap of GDP back to 100%. Of course, that's assuming that GDP doesn't fall, and GDP is going to fall.
Mm-hmm.
So just to bring the market back into some semblance of reconciliation, valuation-wise, it would have to drop to about 40%. I would look at a minimum 3,100 to 3,300 on the S&P 500. That's a bare minimum for me. Of course, I'm always, I'm here every day, and I trade. Infrequently, but I do trade as the model tells me it's time to make changes. So I'm, very capable and willing to change when the facts change. But I have to say, I think the Fed put is just so far away. If you think about what the Fed had to do in prior crises to get, to right the ship. So we have a crisis. The bond bubble has broken. We had the equity market break, or starting to break, and the real estate market is just now starting to crack. And I want to get to a lot of thoughts in my head, trying to get them out all at once. So
yeah, sure.
We have time. So
we're going to come back to real estate too. Don't worry about that.
Okay. So I just want to say that the bond bubble was undeniable. We had, trillions upon trillion, over $10 trillion of negative yielding debt. The US 10-year note was yielding 0.33% at the nadir. Junk bond market was 4%. Home price to income ratio, all-time record high, a record increase in home prices. And we just talked about the 210% total market cap to GDP. So we have this issue. These bubbles are bursting, and the reconciliation, I call it the grand reconciliation of asset prices, is going to occur. The Fed is going to do it, and just the business cycle is going to do it. But it's not just the United States. I want to hasten to add that over 80 global central banks are now tightening interest rates. The United Kingdom is projected to be in a recession in the second half of 2022. European Union, recession, second half of 22. Japan, in a recession. The United States, 2 back-to-back quarters of contracting growth. China, their manufacturing sector is in contraction because their real estate is in a debacle. The real estate complex is a complete mess. And in China, the real estate is the economy. So we have a global recession now. It's not just the United States. So I think this reconciliation is inevitable, and at a minimum, it's a 40% decline. Did I answer all your questions? I think I was going to talk about Powell too.
No worries. Well, you opened a bunch of doors here, and feel free to talk about Powell. But so you talked about magnitude, which was great. In terms of timing, back to my question about sort of when do you think the market is going to get the memo? Is it going to be as we begin to have these earnings recessions that you're talking about, where companies just start having to give out, just truly disappointing forward outlook? I guess my question is this something that you think is going to be breaking between now and the end of the year, when the eye of the hurricane is here in full force? Or do you think that we're going to be in denial up until we just can't be?
Well, I think corporations will deny as long as they possibly can. I can't predict when when the confessions will start to come from Wall Street. But I think the buy side is going to have an epiphany, and talking about a Powell pivot is ridiculous. People will have to protect their retirement. Anecdotally speaking, I have to say that people who are not in this industry, people who have 401ks and pension plans, how are you doing? I asked them the question. They say, I think we're doing really, really poorly, but I don't care because I know it's going to bounce right back.
Yeah.
Yeah, this is where I wanted to go. Thank you for leading me there. So in the past, the Federal Reserve had to cut rates significantly and go back into QE to right the ship. So when the dot-com bubble burst, the Fed had to cut rates by 475 basis points. In the aftermath of the great real estate debacle, the Fed cut rates by 525 basis points and had to go into QE. If you look at what happened, even in COVID, the Fed had to go back to ZIRP from 1.75 to zero interest rate policies, and had to promise unlimited QE. And here's the way my mind thinks about this, Adam. How soon after a 9.1% CPI print will the Fed be able to return to ZIRP and unlimited QE? I think it's going to happen. I'm not saying it's not going to happen. I'm saying it's going to happen. But that is going to be a painful pivot for someone who is renowned, world renowned for their pivots.
Right.
I call him Powell the pivoter. So he's going to pivot. He will pivot again, but it is going to be in response, ex post, the freezing up of the credit markets where commercial paper can't be issued. Junk bond market is frozen. We had a lot of issuance in July, and everybody said, "Hey, look, credit spreads are tightening again. Let's start, tapping the credit markets." That's not what Powell wants at this juncture.
Right.
So when those markets freeze, Powell will assent to cutting rates slowly back to zero, and might have a tangential move towards QE to try to unfreeze the credit markets. But for them to go back to ZIRP willy-nilly like they did in the aftermath of the COVID breakout, I think is ridiculous. I think that is going to be he will be loath to do it, because what is he going to do if he has to go back into ZIRP and QE unlimited within quarters of having a print of 9.1%? He's basically saying, "Hey, I throw my hands up as a central banker."
Well,
we're going to have protracted stagflation for as far as the eye can see. Just live with it, because it's better than a deflationary depression.
if you enjoyed this video clip, click here to watch another one you should like.